Hey, it's Amber Kovarik, a 17-year mortgage veteran and a subscriber to the Mortgage Coach community for over a decade now. And I know that across the country, we're dealing with low inventory and everyone's trying to figure out solutions to help our clients win their offer and be able to purchase that perfect home for them. And a winning strategy that we've been using with great success is our appraisal gap strategy. So essentially what we're showing our clients is that anyone who has a conventional buyer with 10% down or more, we're showing them how we can leverage mortgage insurance to help them make up a fairly sizable gap between the appraised value and their contract sales price without it costing them very much out of pocket. And by utilizing this strategy, what you get is a buyer that's more confident, that's educated, and that is ready to make an aggressive offer and win. Let me show you what this looks like. In this example, we had a client that wanted to purchase a home that was listed for $375,000. The realtor was suggesting that she would need to go in around $420,000 to be able to win the offer, and she was putting down 20%. Now remember that you can utilize this strategy as long as someone's putting down 10% or more. But in this situation, I showed her what it would look like if she went under contract at $420,000 and it appraised at $420,000. Here's her loan amount, the approximate payment, and her cash to close, the 20% down plus her closing cost. I also wanted to prepare her for the possibility that the home does not appraise at the contract sales price. And so I showed in one example, so client, if we say that this home appraises $25,000 under our sales price, I want to show you how we can make this work without it costing you dollar for dollar out of pocket. So in this example, it's a $420,000 contract sales price, but we have a $25,000 gap. We're keeping the loan amount the exact same, which means the monthly payment is exactly the same. So now we went from an 80% loan to value to an 85% loan to value because we have to use the lower of the two, the sales price or the appraised value. And so now we're in a mortgage insurance situation. But instead of having her pay monthly mortgage insurance, we looked at a lump sum mortgage insurance policy, buying out the mortgage insurance for the life of the loan. So you will see the only difference in scenario 2 is that her cash to close is a little less than $1,300 higher. And that's because that is the cost of the single premium insurance for her scenario. I also wanted to show her what if the home appraised at the list price of $375,000. Now we have a $45,000 gap. What does that look like for you? Again, same scenario. Keep the loan amount the same. The monthly payment stays the same. Now with the $45,000 gap, we're at a 90% loan to value. So we're in that next higher mortgage insurance bucket. And the cost of that single premium insurance goes up to about $5,000. So you'll see that increase in the cash to close. On this analysis, I can show her by clicking on the closing cost tab. Right here are the single premium mortgage insurance amounts that we are using to buy out that insurance, allow her to go in and make an aggressive offer that's $45,000 over list while still keeping her cash to close within her comfortable budget. She is so excited. She feels like she can win in this market and she's comfortable with all of the numbers. This is a winning solution. And my suggestion is that you make sure that your lender is educated on this and you have them be the one to really dig into the details with the client to make sure they qualify. The mortgage insurance cost is going to vary per client based on their different factors, but just letting your client know that your lender has this ability to provide a strategy for them that is winning in this market. Thank you so much. I hope this strategy is a winning solution for you and your clients. If you have any follow-up questions, please don't hesitate to reach out to me.